Hello traders, welcome back to Nova channel and let's start another interesting topic today. I will introduce to you the 5 immutable principles from DOW theory that is Rails guiding traders to success. Let's get started. DOW theory is the foundations of all technical analysis, yet many regard it as a dry concept suitable only for academics. However, if a trader maintains that mindset, they surely will not survive long in the market. Today, we will explore the 5 core principles from Charles Dow, the father of this technical analysis, that I believe will change your mindset, attitude, and trading approach. Firstly, Dow teaches us that the market does not move in a straight line, but is the aggregate of 3 intertwined trends. The first one is the primary trend. It's lasting several years. This is the major trend, setting the long-term direction of the market. Next is the secondary trend. It's lasting from 3 weeks to several months. And these are the major corrections or pullbacks within the primary trend. Multiple secondary trends form one primary trend. And the last trend is the minor trend. It's lasting from a few hours to several days. However, this is the least sustainable trend, having more noises than the other two. Crucially, this trend is favored by the whales because it's easier to manipulate prices here. The important lesson is price manipulations only happens in the short term, but in the long run, prices will revert to their intrinsic value. And the second principle is about market trends always have 3 phases. Furthermore, a trend, whether bullish or bearish, is formed by 3 psychological phases. Our job is to clearly identify each phase to estimate the trend's next move. And phase 1. For the uptrend, it will have 3 phases. And the first one, we usually call it accumulation. It restores confidence in the crowd. In this stage, only smart investors quietly accumulate positions. In phase 2, that is the public participation. That's the time the crowd starts joining in large numbers. And the last phase is a distribution or speculation phase. The crowd is overly confident and greedily chases the trend. On the other hand, for the down trend, is to have 3 phases but opposite. The first one is distribution. That is the time the crowd becomes weary of the market and sell-offs. Phase 2 is the time for panic or doubt. The crowd starts selling more heavily amid suspicion. And last one, phase 3. That is the time for panic and desperation. Many traders selling in panic is leading to widespread sell-offs. And the critical lessons I want you to remember is always monitor market sentiment to estimate which phase the trend is in. For example, if the market is overly excited and the crowd is frantically advocating buying, that is the final phase of the uptrend, preparing to transition into the first phase of the downtrend. And next, we will move to the third principle. All news is reflected in the market. Have you heard of the efficient market hypothesis? That concept means all information that occurs in the market will be reflected in the price. Therefore, we don't need to spend too much time researching news, because even if we know it, it's already priced in. If anything, studying news and events is to anticipate and analyze future movements, which give us clues for upcoming buying and selling. However, current information cannot be used to trade on anymore. And the next part of today's topic is the fourth principle. Trading volume confirms and directs the trend. As I've shared many times in my articles about volume, this is an immutable theory. Volume is an indispensable factor for confirming the strength of a trend. More specifically, when a trend shows signs of weakening, it's often accompanied by low volume. Conversely, when volume is high, the trend is usually very stable because it has volume support. And the lesson you have here is you absolutely must pay attention to the volume because volume confirms price. Volume is something the market makers cannot hide. Now we move to the last principle. The trend will continue until evidence of a reversal appears. And finally, Dow believes that prices move in a trend. A trend reversal is very difficult to predict accurately, unless it actually happens. However, A trend, according to Charles DOW, remains in effect until concrete evidence confirms an official reverse. For instance, uptrend turns into a downtrend where lower highs and lower lows are formed. And the most practical lessons from this primary is you don't try to predict the trend and act against the current one. Just flow with the existing trend because ultimately you only sell the absolutely peak ones or buy the absolutely bottom ones within a trend. And these are 5 principles from DOW theory that you can refer to improve your mindset and skills in trading. I hope it's useful for everyone. Don't forget to like and subscribe for Nova YouTube to receive more helpful information for your trading journey. Happy trading and see you in the next video.